9 a.m. in Shanghai, Shenzhen, and here in Hong Kong, you're watching The China Show. I'm Yvonne Man with David Ingles.
Good morning. We're counting down to the open of markets in Greater China. Our top stories today, stocks across the Asia-Pacific and precious metals on the up. That's after this week's wild swings with a strong U.S. factory reading helping boost sentiment.
India and the U.S. striking a deal to cut tariffs to 18%, with President Trump saying India will stop buying Russian oil.
Also ahead, China bans hidden car door handles, outlawing a design made popular by Tesla following several deadly incidents.
President Trump unveiling a $12 billion critical minerals reserve to minimize reliance on Chinese rare earths.
And I'm April Hong at the Singapore Air Show, where leaders in global aerospace and defense are gathering for the 10th edition of one of the world's most influential aviation summits. We'll discuss the business environment and impact of geopolitical headwinds with Rossow Aviation and Philippine Airlines later in the show.
All right, we're finally getting some calm across these markets. It feels a little bit more normal.
Yes.
After what has been a whirlwind in terms of precious metals. So at least we have seen maybe some dip buying when it comes to the whole commodities complex. That certainly is one thing that's helping with risk sentiment here today. But certainly there's a lot of talk about, where does it leave people? There's a lot of households, even Chinese investors, that are still nursing their wounds here when it comes to what happened with gold and silver.
Yeah, the crowd that got in quite late. And I think today you look across Chinese media, we'll talk more about this later, you have some banks tightening some supervision around risk as it pertains to risk appetite and retail investing. We'll get into all of that in a moment. Dip buying, of course, as far as the copper story is concerned. You did some state buyers. We'll talk more about that too later on. What's interesting, though, is clearly we're in much better shape today than we were this time yesterday. There was, though, somewhat of an underperformance overnight in Chinese assets, amidst the broader comeback of stability following the U.S. eco print.
It's been a weak start to the year. And I think we were expecting at least the December numbers were looking a bit better, that maybe we would kick off 2026 on a better note. But I think this was, the fact that we're back in contraction when it comes to PMI, that certainly is a bit of a warning signal that maybe there needs to be some more urgency on the policy side of things. I think B.E. Changshu and her team that says, February is going to be that window that we might need to see some easing now.
Okay, as we approach, of course, the long holiday in about 2.5 weeks or so. So we'll see what happens with this going into the thick of Feb. Just on that very note, right, a quick glance at market action. As you can see, things are largely stable, if not reversing, almost completely. In fact, when you look at Korea, which closed lower over 5%, we had, of course, that big trade deal overnight between the U.S. and India. The move today, on your screens, doesn't quite capture the full move. The momentum certainly is continuing following the move from the overnight session. The dollar is weaker, which I guess helps. Silver is up 8%, just a normal day in the precious metals market. Although we've been tracking 10-day vol on this one, still generational high, right? Highs in at least 45 years on 10-day vol, actual vol on spot silver. Copper is also coming back as well, so we're looking at this entire cohort of metals across the Chinese markets, and we'll see what happens with that. Speaking of just the largely stable but underperforming cohort overnight, and as you can see, despite the U.S. rally, we did see, of course, some of the proxies overnight falling 1.3%. The approach to the open to the A50 futures, you have copper coming online. Dollar China, 5,500 is the level to watch in the Hang Seng Tech Index, and we are called higher going into the Tuesday session.
Yep, so in terms of your agenda here today, the energy material side is certainly going to be still a top thing about whether we do see this, sustained moves when it comes to this recovery. Autos is very interesting here when we talk about the changes that we're seeing from regulators here on these hidden doors among EVs, and really this is going to impact a lot of the EV sector here today. So watching that sector very closely. There is a trading debut with East Rock. We're talking about F&B, and then Wuxi Lead Intelligence, certainly one to watch there as well. Certainly we've been watching the listings there. Alibaba and Hong Kong retail sales to kind of wrap up the day there too, Dave.
Yeah, the Alibaba story, I think, is down to a separate report on
India, is it?
In India and financial and Alipay. So we'll see if that has some bearing on trading today. A couple of levels to watch because we took some out yesterday. We did see some support on some. So CSI 100-day, MSCI China 50-day moving average. Worst day for MSCI China going back to November. And of course, we talked about the 5,500 level on the Hang Seng Tech Index. We did manage to close just above that yesterday, so we'll see what the future holds in about 20 or so minutes from now.
Let's bring in Kinger Lau, Chief China Equity Strategist at Goldman Sachs. Great to have you on. It just seems like precious metals has been kind of taking the spotlight, even among Chinese investors that have been pretty burned from this sort of whipsaw that we saw across the metal space. How do you think that impacts, if anything, the equity market?
Well, certainly is disruptive in the short term, and you can see the price actions yesterday or in the past few days. I think it has created some spillover effects from a liquidity perspective. That's why you see what I would call as undiscriminated selling across different cohorts. Yeah. But I don't think it changes our overall or overarching thesis on Chinese equities for this year, which is that we think the market will continue to go higher. But the driver of returns will likely shift from valuation expansion, re-rating, which was the case in 2025, to earnings growth in 2026. So on our forecast, we think that corporate earnings will accelerate, the growth will accelerate from 4% last year to 14% this year. So that will be the major driver of equity returns for China.
And what's going to drive that earnings story in terms of industry groups?
Well, there are a few things. So thematically, I would say the key things would be AI. So AI implementation, AI investment would be one of the key contributors to earnings growth. On top of that, I think the trend for Chinese corporates going global, that would be conducive to profit growth for the aggregate sector. And last but not least, anti-inflation. That would be the key in terms of creating better supply-demand profile for particularly cyclical sectors. But when it comes to sector, tech would be the key one.
Why do you think tech has underperformed the last few months? Hang Seng Tech specifically, that's almost close to testing multi-month lows on the benchmark itself, on the Hang Seng Tech Index specifically.
Right. A few things. I think tech is a very broad sector, so I think the ones that are lagging somewhat are sort of the software, internet technology companies, but hardware tech, they're still doing very well. So I think we need to be a little bit more selective in terms of picking the right pockets, but overall, from a profit growth standpoint, we think this will be the big year for tech.
How much does the macro picture change, if at all, this year? I'm just wondering, largely last year it was completely divorced from this market, right? People didn't really care about the fundamentals. Do you think in this year this is going to be continued the case where, AI is going to continue to drive this whole market higher and we forget about what really is happening in the domestic economy?
Well, I would slightly push back to the idea that we're talking a complete dichotomy between the real economy and the financial markets. Because particularly for this year, we think that GDP growth will be quite solid. So we have 4.8% real GDP growth for China, which is somewhat above consensus. And the main driver of that is, besides investment, domestic consumption, is exports. We think the export momentum for China will remain very solid going into 2026. So I think that provides some fundamental support to the market, and that's why we have relatively bullish views on earnings for this year.
Yeah, and I think you go back to the going global theme that you mentioned, right? Is that mostly is that a car maker story? Like, what sectors do I look at to take advantage of the going global?
I think the perception among investors is that China is selling a lot of what we call as tradable goods to the world, right? EVs, textile, and things like that. But I think the other quite important and emerging trend in terms of export story for China is we are selling more services to the world, right? Look at healthcare companies, look at cultural, entertainment. But overall, we think the export story is looking really attractive longer term. I think one thing that maybe just to flag, if you look at S&P 500 companies, for example, right now they generate about 28% of their revenues overseas, but for China, in aggregate, across A, H, and ADL, 6,000 companies, on average, we're talking about 16%. So the market share gains from China corporates and from a global perspective remains very compelling.
Okay. So in terms of the playbook this year, what would be the best sort of portfolio to have when it comes to Chinese equities?
Well, let me say a few things that kind of across the whole equity universe. From a market perspective, we like both A and H, so we remain overweight in the regional context. From a sector perspective, as I said, tech, AI would be the key theme. Besides that, we're also overweight on insurance. We think there's a pretty good story to tell when it comes to better equity market performance and valuations being undemanding. We're still overweight materials, despite the correction in precious metal prices, because we think this is a very good proxy for the anti-inflation push by the government.
Yeah. Can I ask our producers to bring the materials chart up again? I think the point you're making, too, is we've really seen a substantial rally in whether that's the CSI 300 materials index, I think, or the MSCI gauge also has, there we go, quite substantial. How are you looking at valuations, given a rally that's, let's call it prices about doubled from about last year?
Yeah, indeed, it was the best performing sector in 2025. And we think that momentum is going to continue because we think the demand-supply backdrop remains quite favorable for most of the metals cohort. On top of that, if you look at valuations, we're talking about mid-cycle valuations. We're not talking about very extended valuation from here. So clearly, a lot of the good news is already in the price, but we think the momentum is going to continue.
Okay.
I was going to get your take on the latest report you guys came out about whether this stock rally is actually helping in terms of generating wealth, that whole overall wealth effect. You're saying that it actually doesn't create that sort of boost to consumption. Why are we not seeing that play out?
Well, let me kind of take it back. And we would say incrementally it's helpful, but what we're trying to say is relative to the size of the housing market, right? Because the housing market is still a big part of the Chinese household asset allocation. Right now, Chinese households still allocate about 55% of their wealth in the housing market. And given a downturn in the housing market, we think the rally in the stock market may not fully offset the drag from the housing market. That's the key point. But clearly, sentiment has improved. You look at all our indicators, which suggest that retail investors are now become more risk-loving, less risk-averse.
Well, they're buying silver.
Yeah, buying gold, buying silver. And I think what we can see, particularly in Hong Kong, I think we're seeing some spillover or kind of the help from wealth effects. So in aggregate, it's not going to move kind of change the whole picture, but I think for select sectors and areas, I think it's helpful.
Best tactical opportunity, and let me caveat that we saw a massive move in property names since we talked about the housing story as the biggest potential driver of consumption. To the point, is that a good tactical opportunity? If it's not that, what is?
Well, fundamentally, we think the housing market is still going through a downturn. So we think the housing prices may bottom sometime in the next 12 months. So we still have another 12 months to go in terms of the downturn. But when it comes to policy support, we think the government is going to focus more on the property market this year. So when it comes to tactical trade, given how much the stock prices have fallen, then I think some investors might see it as interesting opportunities. But when it comes to areas outside of the housing market, we think tactical trade, I would say commodities. Given a downturn, given a sell-off, I think it's time to re-engage.
Okay, wow, exciting. Fantastic. Kinger, thank you so much, as always. Nice to see you, sir. Kinger Lau, their Chief China Equity Strategist at Goldman Sachs. Coming up on your screens, 9.5% in Tokyo. Buyback, 500 billion, that's Japanese yen. Fiscal 2027 going into 2028. So we're going into that fiscal year specifically in a couple of months. Shares are up 10% there as far as the Japanese company is concerned.
Yep, they've also raised their full-year operating income outlook, really beyond market estimates as well. So the guidance was also good on that hike. Growth hopes and the like is really kind of leading the shares the most in a year, really, in the highest level since 2000. For Kyocera. Coming up, China bans the hidden car door handles made popular by Tesla in a world-first safety policy. Well, the details coming up next. And we're counting down the open of trade in Shanghai, Shenzhen, and Hong Kong. This is The China Show.
Right. Big news overnight in the auto industry could have global repercussions here. So China is banning concealed door handles on electric vehicles, becoming the first country to outlaw a design originally made popular by Tesla. On your screen, some of the graphics to help explain these graphics and the broader implications. Min Lau, our China correspondent, is here with us to tell us more about these new rules.
Yeah, so the Chinese authorities have put out pretty specific rules, including just exactly how big the door handle should be, like how big the recess is there for the hand to go in to grab the handle. It requires a mechanical release both inside and outside the door, and a signage inside to tell people how to open up those doors. And this comes after a spate of deadly accidents, right? Remember, mid last year, there was a Xiaomi car that caught fire, and oftentimes people can't escape when there is a power failure and they can't open the door. And so this has come under scrutiny, and because China is such a huge market, industry analysts are saying that it has the potential to influence global norms, because Chinese car makers are unlikely to, it doesn't make sense for them to have different car handles for different markets, so it could potentially be exported across the world.
Okay, so this is, of course, the first sort of regulation that we've seen when it comes to these sort of handles. What's it going to take to kind of make these changes? What costs and impact would this have on car makers?
Yeah, so one of the biggest costs is the remodeling of the cars. So some sources in the industry are saying that it could cost more than 100 million yuan per model to redesign the car handles. And at the same time, it also makes some of the existing measures obsolete. So some models, they have, for example, the backup batteries for the cars. The Teslas have these hidden mechanical pull cables to release the cars. Oftentimes they are hidden under unlabeled pedals, could be under a mat, could be in a side car pocket, for example. So these would be obsolete. Tesla, for one, their car handles have also been under scrutiny in the US as well because of accidents. So they have said they will comply with these rules. They will try to make their mechanical release systems more intuitive as well. And this is just the first of many new rules that are to come, because the Chinese government is also looking into, for example, regulating how fast a vehicle can accelerate from a standstill, and also ramping up oversight of the driver-assisted systems as well.
Yeah, it's interesting, some of the figures here, Min, in terms of just clearly a lot of cars have the design that they need to be revisited. I wonder what people are saying on social media, because some people just purchase a vehicle. Some people have paid for something, they haven't taken delivery of it. Do they change their mind and wait for the new ones to come out?
Yeah, it affects many models, because about 60% of the cars available now among the top-selling EVs have these concealed door handles. But actually, people online are very supportive of this because of the accidents we have seen, right? And people have been complaining about the car doors for a while. Some people are saying that the rules should have come in much earlier, and safety comes first. And some people are saying that the new car doors have no other purposes except to look good, and some are saying it doesn't even look that much nicer. Yeah. And personally, I actually don't really like the press to release door, because you have to press it with one hand and open with another hand, so you need two hands to open the door. It's a bit complicated, but many of these car makers are...
I'm trying to think, do I use two hands? I think...
You have to press it to pop it open.
Yes, it is.
So if you're carrying a lot of things, it's kind of difficult, right?
I see what you're doing. Okay.
Yeah.
All right.
Yeah, so people are supportive of the changes.
There's a safety aspect to it.
Actually, some engineers are saying the original intention of these hidden car doors is actually to reduce drag, but the impact is very minimal. Some engineers are saying it could increase your range by 5 to 10 kilometers.
Really?
Yeah. But yes, safety comes first.
All right, Min, thank you. Our China correspondent there and we'll check the EV space when they do start to reopen the pre-market here. Another scoop that we're watching out for is Elon Musk, right? SpaceX has acquired his artificial intelligence startup Z.ai ahead of a planned IPO set to value the company and the combination at more than $1 trillion. Let's bring in Belle. She's been tracking the story for us. What do we know at this point?
What we know at this point is that it's really, I guess, bringing together Elon Musk's overall ambition, which is to dominate both AI and also space exploration. So this combined entity is interesting because obviously SpaceX has been one of his most successful companies, or one of his most successful startups. XAI has a really significant cash burn rate at this point in time. So bringing these together essentially is what he is saying is the most ambitious, vertically integrated innovation engine on and off Earth. That's a quote that he has in the memo that he gave to employees. But you can see here just some of the metrics around it. Now, this is according to our sources, this information. It wasn't confirmed by the company aside from the merger, but in terms of the valuation, that $1.25 trillion, that's $1 trillion for SpaceX, $250 billion for XAI, and then also still pursuing possibly an IPO this year. That's what we're again hearing from people that are close to the matter. Shares could be priced at around $526.59 apiece.
How did Elon Musk explain the logic behind the deal?
This is a logic, essentially, that we've heard from. He's not the only one. There's a number of different space companies that are trying to do this, but it's about putting data centers into space. So his idea is that in the next 2 to 3 years, the best way to do AI computations is going to be going into orbit, and that is something that we hear, for instance, from Jeff Bezos's space company as well. There's StarCloud, for instance, it's already launched or started that launch of putting data centers into space. So it sounds really good in theory because you're getting cheaper energy, you've got potentially infinite space, or you do have infinite space, but at the same time there are really significant engineering hurdles around this that they still need to deal with as well. So you've got to be able to maintain these massive solar panels, you've got to be able to withstand or protect the electronics from these really harsh cosmic rays as well. So there's lots of different sort of obstacles or hurdles that they still need to get around, but that's sort of what Elon Musk is thinking here, is this is where he sees the AI landscape moving.
Bill, thank you. Annabelle there on the latest deal. Just very quickly, we're at 27,000 on the Hang Seng Index. We're looking at some miners, some big financials leading the early gains here. 6 minutes to the opening bell. This is the China Show. A rally is the likely early scenario across these markets. Call it 1% on the Hang Seng Index. Some strength coming through in the Chinese currency. As you can see, sub 694 now on the offshore gauge. A couple of stocks to watch, and across sectors, of course, given just how different things seem to be this time around compared to yesterday. Yeah,
we're watching some of these rare earth stocks here today, according to our reporting here about President Trump launching this $12 billion minerals stockpile when it comes to rare earths as a way to counter China. You are seeing some of them rallying here this morning. CMOC getting an upgrade here when it comes to HSBC. So raising the 8 shares to a buy here with a price target of just around $24.90 right now. So the stock is up some 6%, but certainly we're watching, of course, the copper story and how that all plays out. Zijin Mining, HSBC, also moving quite a bit here, Dave.
Yeah, HSBC, of course, has been leading one of the outperformers in the last couple of weeks. Markets are taking this opportunity to buy into that dip. Zijin Mining, of course, on the back of the dip in gold, and hence the stock price, too. East Rock is a trading debut today. Should be coming up on your screens. We'll talk more about it as we approach the open, coming up next. Right, welcome back. Going into the open today, we're feeling the tailwinds coming through, right? Surge in Tokyo and Seoul on the Kospi Index, if you're curious, that takes us back to levels around 9:05 a.m. yesterday. There we go. So almost all the way back. So hence, this is the world we're in, right? We're getting a 5% move, which we're treating as normal. Copper's up, silver's up about 7% last we checked, and that seems to be on the lower side given the bigger moves we've seen recently.
I mean, the vol, certainly it's just you have to contend with this vol, and
right.
You know the indigestion that you're feeling certainly is not just you, right? We certainly are feeling it here on the desk as well as we track the price action here, which has been kind of back and forth really when it comes to the precious metal space. But at least today, we have seen a bit of stabilization on the commodity complex as well, so that is helping at least sentiment when it comes to equities, right? So you take a look at copper, for example, seems to still recover. Shanghai crude crude, though, somehow still heading lower by about 4%. But certainly we're seeing when it comes to the onshore market, CSI 300 is up some 1% here today. So we are doing much better than yesterday. Capricorn Tech is up 1%. Some of the big sort of insurers, which Kinger Lau from Goldman saying, given the equity volatility and the like, should be benefiting this part of the financial cohort there. We're up 1% for Ping An Insurance as well. We'll watch closely what happens with the EV space, just given that the story from China about how the new regulations when it comes to EV hidden door handles and whether that applies to the supply chain like CATL. Not much movement there so far, but Kuwait Malta is also up some 1.5% or so. So let's see if we can drink up this risk sentiment here, drink up a bit more risk here today in Hong Kong. Let's take a look at how this dashboard is looking like here today when the rest of the markets are doing quite well, right? When you take a look at, Japan's up 3%, Kospi is close to 5% gains here. HS Tech is bid up here with the Hang Seng now closely going back to that 27,000 handle there as well. We talked about HSBC and really how in the financial space this has been one of the outperformers. We're up another 2% here. Also watching, of course, the EV space, which we'll get to in a bit here. Dollar China is still on the stronger side of things. We're at 693 levels here. Certainly what we've been in the property space, there you go. HSB is up another 1%. So, so the property space, financials continue to do quite well. Tech as well today, at least, is also leading the charge with Baidu and Tencent as the exception, though. We're watching, of course, the auto stocks as we talk about here. So, China is the first to ever kind of do something like this here, right? Where they're banning these hidden car door handles. What's going to take for, automakers to redesign these models certainly is going to be the big factor here. Analysts have said, it's really the high-end luxury sort of models that might be the most impacted. NIO, certainly maybe you're seeing that as well. We're down 2% there, but the rest of the space looking a little bit better, taking it in stride for now. There is a listing debut to tell you about here in the Hong Kong Exchange, East Rock. This is a beverage company. There you go, unchanged for the stock so far. So not much investors. Yeah, for once. They're not drinking it up right now. No. Rare earths, this is the big one as well. When you talk about what the U.S. is doing here in launching this $12 billion minerals stockpile when it comes to rare earths as a way to counter China. You are seeing some of these rare earth stocks rallying on that report. Yeah,
we're also getting some comments coming through here out of the Japanese on that too. Concerned about some of the rare earth curve might be affecting supply. That's down to something else. We'll get to Project Vault in a moment. A couple of other things to tell you about as we go into the thick of things and as we look at this rally across these markets. So a couple of levels to watch. We did see a decent and I think somewhat resilient bounce over on some of these moving averages. MSCI China, of course, is 50-day moving average. Hang Seng Tech, I know that's a nice round number. That's a level roughly where we've seen some decent support going back to, I think, about August or July of last year. Almost took it out, almost closed below that. We're clearly trading way above that, given the rally we're seeing today. Just very quickly, the dollar, a glance at some of the precious metals and, of course, U.S. futures on the back of all the news overnight, whether that's the U.S. economic print or Project Vault, of course, coming through here. Which did lead, of course, to some market reaction in the U.S. session. Nick Wadhams is here, of course, with us on set. He leads our national security coverage. Very nice to see you.
Hey, thanks for having me.
What a time for you to be here in town. Tell us about this.
So basically, the Trump administration is setting up this $12 billion strategic reserve of critical minerals. A couple of things going on. One is it's really designed to insulate companies, private companies in the U.S., so Boeing, a bunch of others, GM, from price shocks and volatility as they try to collect these critical minerals. It's also sort of a shot across the bow with China. The U.S. gets so much of its critical minerals from China. They're really trying to wean themselves off, and in the meantime, basically looking to protect themselves a little bit so that if China decides to further restrict or dial back exports of critical minerals, hopefully there will be a little bit of cushion in the system.
It's sort of what they've been doing with emergency oil stockpiles in some ways, right? How do you think this is all going to be constructed, and how's it going to work with the private sector, too?
Well, so much of the detail has not been resolved yet. It looks like there will be a system whereby companies will essentially get price guarantees. Okay, we agree to buy critical minerals at a certain price level, then we would put critical minerals back into the system. It would also give them sort of more specificity and assurance on what the contracts would look like over the long term, so sort of stabilizing things long term as well as creating a healthy supply. But, with the Trump administration, there's very much a seat of the pants kind of situation, as you have noticed for a long time, where they announce something and then fill in the details later. This is not fully baked, so it's going to take many months to figure out what this actually looks like.
And where are they going to get some of the stuff? Because clearly, if that was an easy endeavor, they would have had the vault already.
I mean, this is the great issue. So what they're doing is essentially saying, here, we're going to look to reduce price volatility and decrease the chance of shocks. But we still have to get this stuff from China. I mean, the issue is the refining capacity. Where is the refining capacity?
Okay.
There are plenty of critical minerals all around the world. I mean, the U.S. has them. Its allies have these critical minerals. In many cases, these are not rare. But the issue is just the refining capacity is such a heavy polluter that so few countries actually want to do it. China is willing to do it. So you still have a situation where U.S. companies will be very reliant on China to procure these materials.
There's the nuance and context. Thank you so much. Nick Wadham's there, who leads our national security coverage here in town with us. Coming up here on shows, the U.S. and India sealing a trade deal linked to the Modi government cutting purchases of Russian crude. The details next, plus analysis from CSIS. Right, welcome back and good morning. If you're just waking up and figuring out why we did see some massive moves in Indian proxies and ADRs overnight, this trade deal, of course, we'll get into the details in a moment, but yes, markets have already reacted to it. We are seeing incremental gains in the Nifty contract as we speak. It's come alive in the last 40 minutes or so. This takes us into, of course, the open today. President Trump says that he will reduce tariffs on India to 18%. So 18, it's not quite as low as peers, but it's low, I guess, enough compared to where that it used to be. Prime Minister Modi then agreed to stop purchasing Russian oil. Derek Wallbank is with us out of San Francisco, our senior editor, to take us through the fine print. Derek.
David, it's really simple here. We're waiting on the text of this deal, so let's sort of keep a pin in place there. But at a very, very high level, the tariff on India goes from 25% down to 18%. In fact, it actually goes as high as from 50% down to 18%. That's because not only is Donald Trump taking the reciprocal tariff down, he's also getting rid of the tariff that was put in place to try and disincentivize India away from Russian oil. Trump's basically declaring here that India's done a good enough job with that and sort of rebaselining the relationship around this 18% number. Unequivocally, I think good news for Indian equities, good news for for Indian companies that have been really, I would say both struggling to figure out how to advance forward in a sort of situation where they were the only country getting this oil levy. At the same time, it answers some questions, I think, that a lot of people have had about the U.S.-India relationship. Remember, Donald Trump and Narendra Modi have made no secret of the fact that they are sort of allies on the world stage, independent of their country, just like personal allies. They have put forward the idea that they have a very warm relationship for years and years and years. And there had been a view in, I think, India somewhat widely that basically says, okay, if we're supposed to be friends, what's going on here? Where is all of this sort of warmth and good friendship and good ties? Where is that gotten us? It's gotten us to a position where we're maybe at a disfavorable trade policy compared to some of our neighbors. And so that had, I think, rankled a lot of people in New Delhi. And this is a chance, potentially for a reset between the two powers. The U.S. ambassador to India, Sergio Gore, said that the relationship between Modi and Trump is great, and he described it as, I quote, having limitless potential, the U.S. and India relationship.
Derek, when the president mentioned about, part of this deal is the Russian oil angle that Modi has agreed to stop buying it. Do we know if the Indians have agreed on a complete halt of Russian crude? What do we know at this point?
Devil's in the details, Yvonne. I think that the president is deciding that we are at good enough right now. And let's see the paperwork when it comes out, right? Let's see what actual commitments wind up being there. But I think that it's pretty clear that the president is trying to sort of move forward at this moment, sort of put a pin in this and go forward. Now, we are waiting on not just paperwork on this, but a paperwork on a fair number of other trade things that Donald Trump has said are coming imminently. So there is a lot sort of at stake there, as well as a Supreme Court decision we're waiting on in the United States in terms of the legality of all of these reciprocal tariffs in the first place. So there may be, some more to be said here. But look, geostrategically, India is a country that the U.S. has been trying to get on side for a very long time. The entire idea of an Indo-Pacific kind of agreement and focus is really geared towards getting India to be a big part of the idea of what the Pacific means in the first place. You've seen the U.S. move forward with things like the Quad, trying to bring India closer in a defense context as well. And this trade policy was really, I think, if you talk to people on both sides of the ocean, you would say that this trade policy was getting in the way of a lot of that, and was really, if you look at sort of where Modi's attention had been over the last couple of months, pushing India a little bit towards some of the nations that the U.S. would rather them not be as close to. I think the U.S. would rather have New Delhi come closer to Washington. Instead, it looked like over the last couple of months that New Delhi was going closer to Beijing and closer to Moscow. And so this is a step toward getting India maybe closer to back on side. And so there's a lot of things kind of going into this decision. Oil may be a headline event here, but make no mistake, this is a larger decision than just about where India buys its oil from.
Yep, closer to Brussels as well. Derek, thank you. Our senior editor, Derek Wellman, joining us from San Francisco on that U.S. and India trade deal. Joining us now from Washington is Rick Rossow, senior advisor and chair on India and emerging Asia economics at CSIS. Rick, it's great to have you on the program. So we've been long anticipating some sort of trade deal between these two nations. Can we call this one a reset for India and U.S. now?
Yeah, I think, Derek had it right. A lot of the day-to-day government interactions have been slowed down because this was such a cinder in the eye that getting this resolved and moving forward is really critical for all the other areas that we want to cooperate on. You've had very little discussions about energy, very few discussions between our Treasury and Finance departments. And that's going to be harder to avoid this year when the United States is hosting G20 meetings all throughout the year. So this definitely should set in motion a lot of the other government-to-government engagements that had really been held in abeyance over the last year.
So Rick, just on that note, then what then do you think we should be watching? What are we ignoring as far as the sort of relationship between the discussions around finance and Treasury?
Well, probably the single biggest thing that keeps getting kicked down the road is actually the resumption of senior level Quad meetings. Now, of course, the day after Trump's inauguration, you had Quad foreign ministers meeting in Washington. They had one more meeting at the minister level over the summertime. But this has been elevated to the leader level, and you really do need the leaders to be able to strike out new directions, create new work streams, and make those work streams really quite concrete. So that's the first thing that I would say. But you do have the World Bank, IMF meetings coming up very soon. So India's finance minister is expected to be out in Washington in 2 months. You certainly would like to see that avoided. The collaboration that we've had in that space, sometimes it's on anti-terrorism financing, sometimes it's on financial inclusion. I'm sure there's a lot of discussions to be had as well over financing a lot of these big initiatives that the United States and India both have on artificial intelligence. So a lot of positive things generally in the finance dialogue. But again, those have been really put on freeze for quite some time now.
Yeah, and whether they can actually separate, the security and the commerce side of things is one thing. I want to bring it back to the link that this trade deal has on the purchases of Russian oil.
Yeah.
How feasible is it for India to actually stop buying Russian crude? Is a complete halt actually feasible?
I think it's feasible. You've seen India actually bend under U.S. pressure in times past for its hydrocarbon purchases from Venezuela and Iran. And you look back 7 or 8 years ago, India had no hydrocarbon purchases from Russia. They got alternative suppliers that can feed in the same kind of crude oil that India needs for its refineries. So there is optionality, but it comes at a price. The price differential is somewhere between $10 and $15 a barrel. But, India's trade deficit has maintained more or less status quo at about $300 billion for a goods trade deficit. And the economy continues to grow. So they can finance and support it if they need to. They got other forms of money coming in. They have a very healthy services trade surplus, a lot of remittances, foreign investment coming in. So they can bear that pain if they want to. And we've seen in other instances they've done. But, we have a president's social media hit saying that this was the deal. We've had other times when India actually did not concur with the president's own admittances on social media. So in the morning, I think hopefully this will get a little bit clearer as to what India actually agreed to on Russian oil.
Yeah, devil will be the details here, Rick. The 18% tariff, which obviously is much lower than the previous setting, but they didn't quite get what the others got in terms of the 15%. Do I read into that as somewhat, the U.S. not being able to get as much concessions out of India, or am I overthinking this?
No, I think you're right. President Trump appeared to press India very hard for market access on basic agriculture products. Basic agriculture, that's really the staple for almost half of India's workforce. Grow small plot of land, have really no ability to get that product out to global markets. So opening up basic agriculture would really impact hundreds of millions in India that don't have a lot of other career options. So there's always been kind of a bright line. It's just a question about when President Trump would kind of agree. It's not a negotiating stance, it's a bright line. But that means that, of course, we're not going to put everything on the table we could have in terms of, offering India zero duty access to the U.S. market. But, also it's important to note that trade between the United States and India has been remarkably resilient. Here we are for a year under trade pressures for many months now where you've had specific tariffs brought against India. And we actually had a significant bump, about 16% increase in goods trade in the last year. So, a little bit of a tail off at the end, but overall, pretty sustained, even in front of tariffs, because there's been big carve outs. The 50% number isn't actually the applied tariff. Some of India's big exports to the United States on pharmaceuticals and things had actually been exempted from that. So we do have a bit of space, even under the old regime, where it wasn't quite as bad as it looks like on paper. But this certainly will open things up.
And as you mentioned, the president likes to kind of throw out really big numbers in terms of all these trade deals that he's carved out with Japan, with South Korea, about the amount investment pledges. This time around, it's a $500 billion one that India will purchase more than that amount of goods. What do we have to look out for? The agricultural side, I know you mentioned, is one thing, but will this actually come into fruition?
Yeah, one big question that was not part of the social media hit on that was what's the time frame we're talking about? India's crossing $5 trillion. It's going to be a $15 trillion, a $20 trillion economy. So if we're talking many years in the future, hitting that number should be relatively straightforward. India, though, it's not a command economy. So ultimately committing to that, if they actually want to execute and carry it through, a lot of that is probably going to happen after Trump has left office, and maybe future presidents are going to be putting a bit less pressure. But then B, you think about the areas the government of India actually controls the purse strings, and it's hydrocarbons and defense primarily. So that's the area where they have a bit of control to move the needle in terms of where they buy from and what they buy. For most other areas, it's actually Indian private companies. Now, sometimes they do bow a little bit to Indian government pressure. But I think, understanding the time frame for that number, how much India expects the government to buy and how much pressure they could put on the private sector, that's, again, the kind of details we're going to look for when we see a little bit more nuance.
Rick, just a broad question just to end. Can investors now, we've seen a lot of progress, right? India, U.S., India, EU, several visits between the Chinese and U.S. presidents to each other's countries this year. Can we relegate geopolitics as a key risk to watch for investors now?
I don't think it's a risk. I mean, at the end of the day, China is the country where India's had the most tension in recent years. Armed clashes at the border, concerns about maritime security. I think India at this moment, they realize, China's been taking a bit of pressure off the border, that a lot of what India wants to move into on semiconductor manufacturing, electronics and such, as you were talking about in the previous segment, you can't do that without critical minerals and rare earths, and China dominates that area. So I think India's kind of resumed trade, trying to rebuild ties. They want to get what they can, extract what they can from the relationship, balance it a little bit more. But when China invaded, the United States was the first country that called and offered assistance. And so I think at the end of the day, when you think about the threats India faces and who's there with them, the United States kind of stands up. So trade certainly has been an impediment to doing other things on the security relationship. But I think India's ready to work with us because ultimately we've been there when the chips were low and not asked for a lot in return.
Rick, thank you for the time. So I know it's getting late for you there. Rick Rossow there, Senior Advisor and Chair on India and Emerging Asia Economics at CSIS. If you're one of our Bloomberg clients, you can rewatch that interview on TV Go. Just run that function. You can scroll back to this or some others that you might have missed throughout the programming today. Plenty more ahead. This is Bloomberg.
All right, checking markets, and we are looking pretty good here right now. If you are long, of course, equities today, Asia Pacific is up some 2%, and you're seeing what really is driving that is Japan. It's Korea today. Look at the Kospi. We're back above 5,100 and seeing gains of more than 4.5%.
Yeah.
The brokerages are certainly what's rallying and driving that.
Substantially. No, I was looking at some of the gains. It made me just like
cough and lose your breath
lose
a
my
little
breath
bit.
a little bit. Yeah. I mean, we're back to levels of this time yesterday, right? So if you fell asleep on Sunday, woke up today, you'd be actually just better off, just in terms of net stress-free and just. What happened? Nothing happened, right? Very quickly, just to mention, too, so we are doing well, and perhaps the last piece of the puzzle will be Indonesia when this one opens up.
Yeah.
Later in a couple of minutes, because this one actually got completely clobbered yesterday on the materials and metals exposure. So we'll see what opens up in about a couple of minutes from now.
And you wonder, this U.S.-India trade deal, is it enough to kind of lift that what has been weighing on this market here, as well as the currency, right? That the India Open is very crucial as well in the next 2 hours. This is Bloomberg. Welcome back to the China Show. Here's a look at the HSI half hour into the session. And yes, we are sitting pretty here today. We're up about 1% when it comes to the Hang Seng, back above that 27,000 level here. 8 shares are also seeing a recovery there today. So certainly, I think now that we have seen at least some calm come back to the commodity sort of space there, that certainly is helping, the rest of the markets and other asset classes as well. The spillover effects, certainly we did see a little bit of that in the last few days or so.
Yeah, some of the crowded trade, some of the too overly leveraged trades, really I think blowing up is perhaps a really good, an apt way to describe what happened yesterday. And things, because of the calm today, we are getting some buying, maybe short covering into the Tuesday session here. So we're up 4.7%. Just speaking of one other market we're tracking very closely, which is the Korean market. So Korea and Indonesia, which we'll get to in a moment, really led the losses yesterday. And it's going the complete opposite way. In fact, flip the page, please. Kospi is up about 5%. Within that, we're still trying to figure out what's driving specifically these massive gains we're seeing across the brokers there over in Korea. All things equal, 2.3% in aggregate on the regional benchmark. Indonesia is just coming online, and that market is still struggling for any positivity. We are opening lower again in Indonesia, 0.5%. Not a lot, but still missing the rally we're seeing. It's very early, of course, so we'll really wait for this one to really get warmed up. Some of the big stocks, of course, on your screens. Very quickly, perhaps the reason why we are getting some stability today is a stable dollar, if not a weaker one. And, of course, as you can see, we're now 10% higher on silver futures. Copper, just to this note, too, right? You have Chinese copper fabricators, manufacturers, because of the dip, were said to be buying that dip to replenish their inventory. That's after this price surge driven by speculative trading in Shanghai, really keeping them away for weeks. That's that. And, of course, there's also this precious metal space that we're looking at.
There's a great story in the terminal that talks about that $7 trillion, cash pile that households have, and where are they putting that money? Well, it's been into stocks, and it's been into gold. Right, so you can imagine just, maybe some of these investors are really still nursing their wounds here right now. When you take a look at state media and the like, recent volatility in the metals market is prompting action from China's major state-owned banks. The Securities Daily reports that lenders are tightening controls on gold investment products and issuing risk warnings to promote more prudent investing. Now, big banks like ICBC, China Construction Bank, and Bank of Communications nations are reportedly raising entry thresholds and adding risk assessment requirements now.
Yeah, let's get more on the metal space with our Asia Energy and Commodities editor, Andrew Janes, is with us out of Singapore to talk us through the many strands to this story. Andrew, let's start with precious metals. What's the coverage like today?
I guess we're seeing some relative calm return to the market. It's been a very dramatic few sessions with, those really steep gains at the end of last week and then the rout of the last couple of days. Interestingly, we've seen retail buyers in Singapore queuing up to buy gold after the rout, suggesting that retail demand is very resilient. We've also got Deutsche Bank came out yesterday and said they were reiterating their forecast for gold to get to 6,000 an ounce. So, yeah, we've seen the sharp pullback, but a lot of those factors that drove precious metals higher, the geopolitical instability, the attacks on the Fed, the weaker dollar, they're still kind of intact.
Okay, so we're not quite maybe out of the woods just yet, Andrew, but what's going on in copper too? Because there was a report that the fabricators and manufacturers are starting to actually buy on this dip to replenish their stock here ahead of the Lunar New Year holiday. Is that enough to put a floor on copper prices?
Yeah, it could set a bit of a floor. I mean, Chinese fabricators and copper processors are the world's biggest buyer of the metal. They process it into rods, wires. And interestingly, the last couple of weeks when copper prices shot up, the data we were getting out of China was showing, demand wasn't that great, showing that this was very much a rally sort of that moved beyond fundamentals, and it was driven by this rotation into hard assets and a lot of speculative buying in China. But now we have seen the crash over the last couple of days, and there are reports that those buyers are getting back into the market buying the dip, and that should set some kind of floor.
Andrew, thank you. Andrew Janes there, our Asia Energy and Commodities editor. What a week it's been for you guys. And what a week it's been for Indonesia as well. We're keeping an eye out on Jakarta here as regulators work to shore up confidence in the index. Take a look at how the JCI is looking at today. So it resumed selling off on Monday, following that 5% in the worst performance across Asia. Today, we are actually looking okay. We're seeing some declines, but pretty much flat. Let's bring in our Bloomberg Insight anchor, Heslina Ahmed. She's in Jakarta and joins us now. You're there for a business conference. I'm just wondering, what are the conversations like on the ground there, given what we've been seeing across this equity market now?
I think sentiment is pretty much very fragile at this stage. It has been quite shocking how Indonesia's story is unraveling at such a rapid pace. If you recall, Yvonne, just a week ago, we had the JCI, hovering at record highs. That $1 trillion valuation was in sight, but no longer the case. 5% further drop just yesterday, and the rupiah is at the lowest level versus the USD. The bond market aren't spared either. So there is a crisis of confidence here. It has been a convergence of a lot of issues, questions around governance, transparency, fiscal discipline, and that's affecting investor sentiment. And don't forget, the MSCI has said Indonesia is at risk of being downgraded. And on the back of that, we've seen the likes of Goldman, UBS, even Nomura downgrading their rating on Indonesia. So not a happy place for Indonesia. What a reversal of fortune. We know that policymakers have taken steps. They've asked Danantara, the sovereign wealth fund, to step in, buy bonds, buy stocks in the country. They've even revised the minimum free float of listed companies to 15%. That's what the MSCI wanted, but that is still not enough. This is, again, a crisis of confidence, and that crisis of confidence takes a long time to rebuild. I want to take you back to just 4 months ago when the former finance minister, Sri Mulyani Indrawati, was unceremoniously fired by President Prabowo. That, some say, was the start of the unraveling of this mistrust in the current government. And it'll be some time yet before that trust can be rebuilt.
Yeah, give us a sense of who you'll be speaking with I guess it's just to get a better understanding of how this story is really likely going to evolve over the coming weeks?
Well, I'm here at the Indonesian Economic Summit, and this is possibly a very consequential meeting because this is possibly the first time that we'll be hearing from the government. I mean, we want some perspective. Investors want perspective amid this backdrop. They want to know what policies will be adopted. They want to seek clarity on the measures taken so far. They want to see what guardrails will be implemented. And I'm really looking forward to my conversation with the Finance Minister, Purbaya, later this afternoon. We'll get insights on, how he sees the rupiah hovering at levels we've not seen since the Asian financial crisis, at the lowest level versus the USD. Is he comfortable where the rupiah is? Does he see the need for Bank Indonesia to step in? And take a look at where the markets are right now. What can be done to reverse the sentiment in the market? I mean, this is an economy of 280 million people, an archipelago with 70,000 islands with great potential. We've been talking about the potential in Indonesia for years now that has yet to be realized. And this is the man who took over the finance position just 4 months ago. The weight is on him to reverse what we're seeing right now.
Fantastic. Thank you. Linda Amin, of course, our co-anchor there in Jakarta. And just to also mention, right, as if this market can't really catch a break, right? So on top of everything we talked about there, inflation came out yesterday, breaching the target highest since 2022. Talk about a complication to consider. Fantastic there. We'll see what happens with those conversations there with Haz on the ground. Right, coming up, we're headed back to Southeast Asia, but this time Singapore, to speak with Dassault Aviation about the business of business jets. So their civil aircraft EVP joins us live in just a moment. It's time to head back to the Singapore Air Show, which is marking its 10th edition this year, and our colleague Avril Hong is there with our next guest. Avril.
Yeah, guys, we know how business jet makers, they're not immune to some of these geopolitical uncertainties. What are the risks? What are the opportunities? Joining me now, Carlos Brana. He is Executive VP of Dassault Aviation Civil Aircraft. Carlos, always great to see you.
Good morning.
We are talking on a day where these geopolitical uncertainties continue to swirl. We saw how aviation seems to be back on Trump's radar. Last week, he's threatening these tariffs on Canada, on Canadian certification of jets as well. Is that a concern for you?
Well, actually, every authority has its own concern. The authorities are working for safety. So it's important that every authority establish its own safety rules. And we, as a manufacturer, we have to obey them. So actually, with Transport Canada, for example, we have all our airplanes are certified. They have rules that do not exist necessarily in other countries, but does not prevent us to get certification in any case.
So you don't think it's going to be a bit trickier with certification with any of these regulators going forward?
Hopefully not.
Okay. Talk to us about the relationship, though, because it was only in July last year that the US and Europe, they achieved that zero tariffs for aircraft products. Then does this become a revolving sort of situation as the year progresses? Is that also a concern?
Of course, if those tariffs were maintained, that would be a concern because the main market for business jet is the United States. So, of course. But on the other hand, you know that we have agreements with the United States which were put in place in 1979. And actually, they were changed the 2nd of April of last year, but they came back, to the normal situation. Let's say normal being the previous agreement. And today, hopefully, this will be the same forever. Hopefully.
Are you fielding more calls from prospective clients or clients that are waiting for jet deliveries that may be a bit concerned about tariffs potentially coming back and being an issue in any way?
But it's sure that some people may be more cautious now when they order an airplane because they don't want to pay the tariffs and nobody wants to pay them, as a matter of fact. But on the other end, again, it seems that the situation has stabilized. So hopefully it's for the long term, and it's the interest of everyone, by the way.
Okay, what are you seeing in terms of the demand that's coming out from the US market, which I think is your most important still?
That's correct. Actually, what we see is that worldwide, the number of flight hours in business jets is increasing, and even over what we had pre-COVID. So, of course, we expect, a certain demand in business jets, and that's actually what we are seeing. And, of course, in the United States, like in other countries as well. I mean, Europe, Africa, the Asian market. And actually, the Asian market is a very important market. That's the reason why, by the way, we are here. Since, Singapore Air Show is the most important air show of this area, and that's where we can have the most chances, to see and to convince people of the interest of our airplanes.
Are you seeing any slowing in demand from China? What are you seeing in that market?
It's true that this market was intense, I would say 10 years ago. It has softened a little bit, but this market can exist anytime. I mean, can recover anytime. Because when we look at the Chinese situation, in terms of industrialization, it's a very industrialized country. So they need the tools to get even better in terms of connectivity, the link between the countries and so on. And the business jet is a tool for that. And the second, the size of the country requires, certain flexibility in the transportation. So when you look at the size of China compared to the size of the United States, about the same. The industry growing with a certain GDP in China even compared to the United States. So for us, it's no question that this Chinese market will increase one day or the other.
Right. How is your Asia growth as strong as you say it is, though, if the Chinese market is slowing? Where is that pickup in demand coming from then?
We have other countries in the area. So Malaysia, Indonesia, they are good customers. We have also Vietnam, which is growing. Filipinos, small market, but growing. The point is that, for example, the geography of those countries is very interesting because you have a lot of islands.
Right.
And also, they are not very well, let's say, deserved in terms of transportation to go, for example, from one city in Manila or one city in Indonesia direct to the United States. You have not so many airlines and not so many flights. And of course, the business jet is a flexible tool to allow people to get their transportation needs filled with, modest airplane going back and forth wherever the people they want to go.
What about the Indian market? What are the opportunities you're seeing there?
The Indian market is picking up for us, at least. We see that there is a growing number of people. There was this policy, the Make in India policy, which has been established by the government. And of course, the industrialization of India is extremely intense. And of course, they need also the tools, to go everywhere when they want and, at the speed they can. So they want to save time like any other industrial people. And so that's why I think the market in India is growing as well.
Now, you sold 31 jets last year. Is that going to be a better number in 2026?
Hopefully.
So
we're working on it.
Working on it. And then does that also mean you're ramping up production in some way?
Again, we're working on it as well.
Okay. What about when you look at the Falcon 10X, right? That's the next up-and-coming jet. Where are you on testing and certification?
But we will start, certification as usual with the European authorities, which is the EASA, so European agency. And then after, we will have the certification with FAA, which is a federal agency in the United States. And then after, we'll widespread little by little. So, but we'll start as usual with Europe, which is where we are established anyway.
Yeah. How does it compare, though, the Falcon 10X to what is already on the market from Bombardier or Gulfstream?
We think the 10X will be a game changer. The most important feature of the 10X, besides the technology we are going to put in the airplane, so the flight control system, all the stuff, we have also a bigger cabin. And this cabin will allow, big people, to interact in an easier manner. We will have 4 rooms, 4 lounges that you can accommodate nearly the way you want. And in terms of size, speed, and so on, we are very comparable. Size-wise, in terms of cabin, we are much bigger, but speed-wise, we are about the same as the others.
Sounds very luxurious. Carlos, we'll leave it there for today. Good to chat with you. Thank you so much. Always nice to have a conversation. Sending back to you guys, Yvonne.
Yep. We'll see you soon, April. And our thanks, of course, to Carlos for that discussion. And we'll have more from the Singapore Air Show coming up as well in terms of the guests and what we're expecting there from the Lion City. We're speaking in a few minutes with the president of Philippine Airlines about the carrier's recent turnaround. You're watching The China Show. This is Bloomberg. All right, some big stories that we're tracking for you today, and perhaps why tech is catching a bid here today was what we saw in the U.S., right? Palantir shares jumped in late trade after its full-year revenue forecast came in well above Wall Street expectations. The company sees annual sales of up to $7.2 billion, almost $1 billion above the average estimate. Palantir generates most of its U.S. revenue from government contracts, including a deal with the Department of Homeland Security. Oracle closed lower in the U.S., though, after announcing it was selling $25 billion of investment-grade bonds to help finance infrastructure that powers AI projects. The move has reassured investors that the company won't strain its balance sheet too much. Investors have placed orders for as many as $126 billion of Oracle bonds, edging out a previous record linked to Meta. A Bank of America survey has found that U.S. corporate bond issuance from AI hyperscalers could surge in 2026. Investors polled expect supply to reach up to $300 billion, and nearly 90% of investors anticipate higher investment-grade issuance, while concerns persist over rich valuations, wider spreads, and U.S. tariffs.
Okay, let's have a look at this. So interesting dynamic, and we've had a milestone to give us an excuse to talk about this. All right, so we know obviously how SK Hynix and Samsung have done extremely well. They're doing extremely well today. So much so that the combined market cap of the two big Korea stocks have now surpassed the combined market cap of the OG Chinese internet names like Tencent and Alibaba. Is this a changing of the guard, or is this just a shifting in the current focus of the market into memory away from platforms?
Yeah, and the way that these two these countries are kind of going at the whole AI race, right? Where Korea has really positioned itself as sort of the crucial part of the global supply chain that fuels AI and global tech, whereas China is more about self-sufficiency and the like, right? So maybe that's why you're seeing much more emphasis on the Korea side of things here, given, as you mentioned here, how tight this memory chip cycle is right now at the moment, that maybe there is more legs to this. But it really is that pivot to the infrastructure side of things that investors are really still very much attuned to right now.
Yeah, and the building blocks have become the memory instead of the sort of NVIDIAs of the world. And yeah, I mean, it's just the two names you have to contend with, right? The world leader and then the contender, which they're listed in the same market.
And at the end of the day, you take a look at a company like Alibaba, its core business is still e-commerce, right? Yeah. It's not a full pure AI play.
No. They're both tech, though. Okay, and sometimes we confuse the two. All right. That's another can of worms. But yes, you can check out more of that story, of course. It's on the Bloomberg terminal, this market cap re-rating in terms of the Korean markets there. Okay, a couple of stocks we're tracking. Z.ai, triple, I think, right? 4% to the upside here on this specific stock. Document recognition model was released, so there's no way to hide your bad report card now. Once your parents get their hands on these AI models, right, there's no way to get around that C on your report card. Apart from this, we're also looking at some of the laggards across the Hang Seng Tech space here. Speaking of, right, and okay, we're now down quite, so we just showed you Alibaba and Tencent. Why not look at them again? Kuaishou is down, Baidu's also down, and the Hang Seng Tech Index, we talked about this level, it's now taken out that specific 5,500 level, and how quickly those gains have evaporated within the first hour of the trading session. It's certainly going the opposite way when you look at the Korea, which we just showed you as well. Asia rare earths are also coming up on your screens, and this is really down to the story overnight. out of the U.S., and what does it mean as pertains to, of course, China's stronghold on the industry here?
Yeah,
Project Vault.
This Project Vault, right,
Yeah.
of how they're trying to engage with, private companies and how they're going to make this kind of $12 billion mineral stockpile that includes, critical minerals, includes rare earths and the like as a counter to China. But as we were talking to our Nick Wanhams, they're still going to use the stuff that comes from China, right? So how this is all going to be implemented is still up for discussion here. But then again, it's enough to kind of lead all these Asia rare earth stocks to be higher here this morning. And we're still watching the auto sector in China as well.
Yeah, the big news coming overnight out of Chinese regulators. They are now looking to ban these hidden corridor handles. They are giving time for the industry, though, to adjust to the timetable, given, of course, a lot of the models these days, in fact, I think the majority of the most popular models do have these features in place. So we are seeing some cost implications. It'll take a few days, of course, for us to really figure out the broader implications of quite a material move on the part of regulators here.
Yep, so NIO, Li Auto, XPeng, Xiaomi, they all have sort of models that feature such sort of handles as well. Perhaps that's why you're seeing NIO down close to 3% here. We have plenty more to come. This is Bloomberg. $11:29 a.m. in Tokyo. Japanese markets are heading into that lunch break. And we're having a pretty good sort of lunch session here as we take a look at this recovery that we're seeing when it comes to equities. Japan is up some 3% when it comes to Nikkei 225 topics. There is that 10-year bond sale that we have to deal with in just a bit. Yields are ticking up higher by 1 basis point on the 10-year JGB. The yen, though, is stronger this morning, just slightly.
Yeah, we've had the walking back somewhat of the comments coming through the Prime Minister on the weekend, talking about how she was not specifically talking about the benefits of a weak currency on the economy. I think the clarification that's come out is that they need to build an economy that is resilient to volatile moves in the currency. There we go. That was the clarification that's come through earlier on as well. Okay, so 3% in Japan, 5% in Korea, declines across a lot of the big tech plays in Hong Kong. All things equal, about 1.8% on the benchmark. U.S. futures are also doing okay, with the exception of two sectors today. Most are actually seeing some massive gains, including but not including the IT sector. Of course, that's more a Korea and Japan play today than it is one that is, of course, here in Greater China, where we are seeing some pressure coming through across Chinese tech. And apart from that, so there's a rate decision coming through as well in Oz.
Yeah, this could be the U-turn that everyone's watching out for when it comes to central banks as well. The RBA rate call just about an hour from now. And really, when we take a look at what the majority is that they're calling for a hike for the RBA to tackle resurgent inflation less than 6 months after the last cut. But let's bring in James McIntyre from Bloomberg Economics. Yeah, he thinks that things are not so clear-cut. He joins us now from Sydney. James, tell us a bit more about that. Is it more looking like a hike or a pause today for the RBA?
Thanks, Yvonne. Well, look, it's one of those very finely balanced things, and when it comes to that, there's going to be some who are on the balance or on the side of thinking that the RBA might, instead of hiking, blink this time around. That's where my forecast is and has been for some time, and really it comes down to what the RBA's view is about this inflation data that we've had a little bit in the September quarter, and then again with the December quarter data, about how much of that they think is temporary. We could use that transitory word that we heard from the Fed all those years ago. No. That's now a dirty word. I know, right? Or whether some of it is an enduring, inflation spike that warrants a policy response. And then it's really going to be a question of, well, how much of a policy response? Is this a return to a hiking cycle for the RBA? We don't think so. If they were to move, it would more be a one-and-done type insurance policy move. So there's a few moving pieces, but the big key thing today is, what does the RBA think? Is this a temporary inflation bump that we're going to move through, or is it something that's going to get them to actually pull the lever and deliver that hike?
Yeah, because you could make the case, James, if they hike today, given that the last move was 6-7 months ago and it was to the opposite, was that a mistake? Why didn't we see this pickup in the data at this point in time? I mean, 6 months is a very short period of time, really, for an economy to turn. How do you think they will qualify that in the press briefing? If indeed they hike, how will they prevent the risk of markets moving in a very hawkish direction and getting ahead of themselves here?
Well, look, the market's response, if they do hike, would probably be that way anyway, because a hike is not fully priced in. So the mere act of them actually lifting that up would be a little bit of upside to where market pricing is, even if it is just the one hike. But you're right, that commentary will be incredibly important. How do they frame it in terms of taking a little bit of a short-term move as an insurance hike, so to speak, or do they signal that this is going to be an enduring tightening cycle? We think it's really not likely to be the latter. That's because of what's going on within the economy. Growth is okay. It's pretty good. It's in line with where they were. The unemployment rate, the labour market, that was showing a little bit stronger on one particular month, but the overall trend is one of private sector employment and hiring within the economy being quite weak still. They need a turnaround there, given what is expected to happen with public sector-driven jobs. That's likely to slow. And then this inflation, is there really going to be enough of a demand pull within the economy? It's unlikely that looks to be the case from the activity data to give this one-off spike that is these temporary factors to give it a new lease on life. That mix suggests that, you could make the case to hike today, and markets have done that. Most of the economists have. That's where the consensus is sitting. But beyond that, articulating a new or returning to a hiking cycle after having just delivered only 3 rate cuts, a very shallow easing cycle, we think that that's probably a little bit too much to see from the RBA today.
James, thank you. James McIntyre there joining us from our Bloomberg economics team. And subscribers can also turn to the terminal for more on this. T-Live Go is your function for the latest updates plus commentary analysis from our expert editors, right? That decision coming through in just about an hour's time, 2:30 p.m. Sydney. And, of course, followed by that press conference with Governor Michelle Bullock.
Okay, the other big story we're tracking is India, and of course futures are going to tell you why in a moment here. Big move overnight, a further 1% move to the upside in the Asian session ahead of the open. In about an hour from now, the trade deal with the U.S. may entice global investors to finally return to Indian equities, which of course logged their worst January in about 10 years or so. Our Asia equities reporter, Ashutosh Joshi, is with us out of Mumbai to tell us about this. How vital do you think this is for Indian equities and the catalyst we have been waiting for so long now?
Hi, thanks for having me on the show. Perhaps this is the day markets in India and investors have been waiting for almost last 1 year. Indian equities as well as Indian rupee and other assets underwent a massive underperformance in last 1 year. Starting from 2025, Indian equities have trailed their Asian and emerging market peers. A part of this underperformance also comes from the fact that India was unable to confirm any trade agreement with the US. In fact, among major markets, India was the first one to overcome the initial impact of the trade or tariffs. But later on, India struggled to finalize any deal with the US. To add to that, India was imposed penalty 25% by the US administration for its purchases of Russian oil. Put together, this all weighed on Indian equities as well as Indian rupee, which has been languishing at its record low levels against the dollar. What this deal means to the Indian markets is that there is a case for sharp recovery in Indian equities, and more than that, the global attractiveness for India to invest in India can now come back.
Yeah, I mean, this is, I guess, one big drag and has really been weighing on this equity market, this trade deal. Now that we have a bit of a clarity, do you think this is going to help Indian stocks overcome their long patch of underperformance against most of its Asian peers?
Yeah, it's hard to say at this point whether India can fully recover from the slump because it's been almost more than a year. In fact, since start of 2026 this year, we saw Indian equities especially extending this underperformance. Month of January was the worst start to a new year for Indian equities in almost a decade. But all these factors now there is a potential can reverse. There is definitely a case that Indian equities can cut down some of the underperformance. Again, we have to keep in mind here that India has very little plays in terms of the AI trade, the hot AI trade that many of Asian markets have benefited from. But at the same time, India's valuation premium, which was among the highest over the regional peers, that has shrunk to some extent, and that also makes Indian stocks slightly affordable for global investors.
Yeah, as you mentioned, right, that valuation premium for India has actually shrunk to the lowest in what, almost 5 years. Is that going to be enough for people to come back into this market? What are some of the key sectors you expect to outperform?
Yeah, labor-intensive sectors such as textile, gems and jewelry, and pharmaceuticals are some of the sectors where India has exports to the US. Obviously, because of lack of any trade agreement, these sectors had suffered. Some of them managed to continue their contracts by taking cost and other expenses, lowering down other expenses. But now with tariffs coming down at par with some of the Asian countries, in fact lower than some of India's competitors in textile segments such as Bangladesh, these industries can look forward to scale back some of the businesses that they lost. Labor-intensive industries are the one area where India continues its exports to US, and these will be the sectors to watch.
Okay, and as the chart just shows our viewers, the move in the futures from overnight does suggest we could erase the losses from January, the worst one in 10 years. Market reaction. We'll be watching it closely. Ashutosh, thank you so much. Ashutosh Joshi there, of course, our Asia Equities reporter. Coming up here on shows, we're back live at the air show in Singapore and continue with the president of Philippine Airlines. A closer look at their successful turnaround next and where it goes. This is Bloomberg. Right, welcome back. So we're turning our attention now to Philippine Airlines on the back, of course, of the 10th edition of the Singapore Air Show. And it's really been quite a turnaround here for the carrier, right? Since the pandemic, since then, of course, it's managed to reemerge stronger than ever. In fact, when you look at the timeline, in quite a short period of time, really, in terms of just being able to turn a corporate around, right? So September 2021, it filed for bankruptcy. And since that point in time, actually, early 2022, going into where we are right now, profitability every single quarter. A brief look at the timeline since that bankruptcy. It's emerged from Chapter 11. Shortly after that, it posted its first full year profit in March of 2023. But since that point in time, it's actually been reporting some quarterly profit. And of course, the latest milestone here around this time last year, about 10 months back, it hiked capex to around $450 million US. And as we were pointing out, 15 or 16, I believe, straight quarters there of profits right now for the Philippine flag carrier, which I think is still, no, I think that's their tagline, the oldest airline in the Asia Pacific. And let's bring in Avril Hong, of course, my colleague. She's there at the Singapore Air Show. Avril.
Yeah, David, we're joined now by Richard Nuttall. He's president of Philippine Airlines, and we want to get his view on where things are going. Richard, it's good to see you. You took the helm at Philippine Airlines not so long ago. How do you think progress has been given the geopolitical backdrop, tariff issues, supply chain issues as well?
So it's a really exciting time, Avril, to be at Philippine Airlines. As we've seen, The results have been very positive for the last 4 years since the airline restructured. We've had 4 years that have been positive on the bounce. And the reality is that we're about halfway through a journey. So we went through the restructuring, and since then we've sort of been stabilizing the operation. Many airlines had issues coming out of COVID with engines and fleet. And I think the real success there was that last year we were awarded the most on-time airline in Southeast Asia from Cirium, which is perhaps a turnaround from what people used to think of PAL. So we're in a great place there. We've also just taken delivery of our first 350-1000, so it's quite exciting times. And I think as an airline, we've sort of clarified where we see ourselves going forward. I think there's been sort of perhaps a lack of clarity in the past. Are we competing with Cebu Pacific? Are we competing with the full-service carriers? And I think we're very clear that the future is as a full-service carrier. So we're now entering a period of growth and a period of upgrading the product. And it's exciting times.
What are the headwinds, though, that you're seeing, Richard, from the tariff backdrop?
So I think that for us, the impact, there has been some impact, but it's not been that high. I mean, North America still remains very strong. I think coming out of COVID, it was abnormally strong because of sort of revenge travel. But it still remains quite strong. I think we've seen a little bit more weakness perhaps in North Asia. Perhaps people have been keeping their money in their pockets until they see how things go. But yeah, I mean, we're okay. I mean, things slowed a little bit, but not much. And GDP growth in the Philippines is 6%. So Philippine outbound has been making up for perhaps some slight weaknesses in other markets.
We have been seeing, though, out of the U.S., sometimes a bit of volatility when it comes to immigration, visa policy. Has that not affected passenger demand at all between some of your markets and the U.S.?
So no, there's definitely been an impact. I think we would say that the passenger demand on a round-trip basis last year was flat, where it had been growing. But I think we saw more competition. Also, perhaps other countries were not seeing it flat. They were seeing a decline. So we've got more airlines trying to take the trade turn from the Philippines. So there's definitely been a slight softening. Although in practice, we haven't really seen any major impact on visas for Filipinos. People have still been able to get in and out. There's been more of a concern when something goes wrong, it goes viral. But in absolute numbers, there's not really been much of a difference. And as I say, the market still remains very strong for us.
Richard, David here in Hong Kong. New routes?
Hi, David.
This year, how are you thinking about new routes and perhaps expanded capacity?
Yeah, so we're looking probably to start up to 7 new routes this year. We've announced 3 of them. We've announced Palau, Saipan. We've also added Guam from Cebu. And I think we've got perhaps another 4 coming. But we still need to put those through the board. So you'll have to wait a little bit before I can tell you what they are. But if you look this year, our fleet's going to go from 82 to about 90. But a lot of that is happening towards the fourth quarter. So I think you'll see the real growth as we go into 2027.
What about how much you can tell us about the traffic between China and the Philippines now that you're seeing? Is it giving you enough confidence to eventually fully restore services there?
Well, so, I mean, we still fly to pretty much most of the destinations we used to fly. We're just flying with less frequency. We are hopeful that the new visa regulation, which allows the Chinese to come with no visa charge for 2 weeks, will help. The announcement's only just been made, so we're watching very closely. And if we see an uptick in demand, then we've got the ability to add capacity. I mean, China's the only real market that is way below what it was pre-COVID. So we really see in the longer term there's a lot of upside there. But we're still at the stage of watching very closely. But as I say, we're ready to put capacity in as we see things change, and we're optimistic.
And of course, you still need to get that through the board. But I'd be remiss of my duty as a journalist to not ask a follow-up there on the 4. I understand you can't be specific, but I guess, are we talking short haul here, or are we talking long haul?
We're talking medium to long. And I'll give you a teaser. There's one very big market that we're not in at the moment. So see if you can work out which that one is.
Oh, you'd be surprised how powerful AI can be, Richard. We'll see if our producers can work up that magic in a moment. Richard, very quickly, we talked about the CapEx spend. 450 million, I think, is what was laid out last year. How are you doing as far as cash is concerned? Do you need to raise any money?
So at the moment, we are okay for cash, but we are looking at our options. I think, after 4 years of profits, we're looking at whether we can go out, and we're looking at sources of raising capital. We're looking to see perhaps if we can get a rating. We're debating that at the moment, because longer term, that will give us more flexibility. As I say, at the moment, we're okay. Our balance sheet is looking pretty strong. But, this industry is fickle, so you want to make sure that you've got the ability to go back to the markets if we need to, accelerate some of the work that we want to do in terms of expanding the fleet and retrofitting existing aircraft.
Richard, you touched on some of this earlier in terms of perhaps clearing the air on how you are engaging in terms of competition with the lower cost carriers. How do you see the long-term trajectory on that front?
Well, so I think if you look at the Philippines, we have 2 very different markets. We've got the long-haul markets, particularly to the US, where we very definitely compete as a full-service carrier. We've got our own advantages there in terms of Philippine cost base. If you look regionally, particularly in the Philippines, it's much more of a low-cost market. There are 3 or 4 markets in the Philippines that have front-end demand, but the rest are very much at the back end, and there we compete with a very, very dense aircraft. And I think in the region, it actually tends to be a little bit more complicated. But I think we're now clear that we need to upgrade the product, particularly in the premium cabins for the business traffic. But we'll still look to keep the seating in the back reasonably dense so that we can still compete with the LCCs where we need to.
Richard, so I just had a look at AI, and let's blame the algorithm if I'm wrong here. So we'll see. You don't have to. You can just nod, but I'll use this as a parting point here. Medium haul, 3 to 7 hours, maybe some destinations in South Asia or the Middle East. I won't go into details there. Richard, fantastic. Thank you for joining our shows today. The president there of Philippine Airlines. Maybe we can talk about those 4 new routes once that goes through the board. Right, coming up here, our coverage of the Singapore Air Show continues as risks across the geopolitical space fueling prices globally. Ayata's joining us, share the outlook for 2026. This is Bloomberg.
All right, we're checking. HS Tech continues to be a down arrow story there. We're down another close to 3% here. If we continue this way, we look to be extending that fall into a bear market, right? That 20% we have dropped here since reaching that October 2nd high, Dave.
Yeah, so across the names pulling the index down today. So you have, of course, index of 30 stocks, 24 down, 6 are higher. The larger ones, though, and as pertains to market cap, so you have Tencent, you have Alibaba, you have Xpeng, you have Neo, all down over 2.5% each. Kuaishou Tech is down 6.5%. So really the drag across that market, and really just to juxtapose that with the tech rally we're seeing elsewhere.
When you're seeing 30% gains in Samsung and SK Hynix, certainly the market seems to be more interested in what's going on in the whole global supply chain side of things and memory chips, for example. But yes, India opens up coming up next. So against this backdrop of pretty good markets here, we'll see how India fares after, of course, U.S. and India agree on a trade deal. The market open in India coming up. This is Bloomberg.